I'm Professor Indra Abeysekera. Let's look at what is leasing. Lease is defined in IFRS 16 as a contract or part of contract that conveys the right to use an identified asset for a period of time in exchange for consideration. So it's a contract that conveys a right, and if this right is throughout the period of the use of the asset, the customer then has the right to obtain substantially all of the economic benefits from the use of the asset and direct the use of the asset. So lease is different from a loan agreement because in a loan agreement, it is the right of ownership that is central to the question, whereas in leasing, it is the right of use of the asset that is central to the question. So the central accounting issue here is who should record the asset or the liability in the leasing transaction. So it comes down to who has the right to use the asset and who has given up the right to use the asset, but it's not about the legal ownership. So there can be two parties here, the lessor and the lessee. The lessor is giving up the right to use the asset, whereas the lessee is acquiring the right to use the asset for a given period. So we have to ask the question, is there a right to use the asset that can constitute a lease? And all leases by default are considered as finance leases. But if the lease period is less than 12 months, then the lessee can elect that to become an operating lease. So what's the impact of choosing an operating lease versus a finance lease? In a finance lease arrangement, the lessee will have depreciation expense because the lessee will acquire the right to use the asset, can depreciate the asset, and there will be also interest expense because there's a lease liability that the lessee will incur. As a result of that, there will be depreciation expense and interest expense. The earnings before interest, tax, depreciation, and amortization will therefore improve, or the EBITDA will increase because EBITDA is a measure that is the earnings measure before interest, tax, depreciation, and amortization. On the other hand, if it is operating lease, there will be operating expenses. The operating expenses will be before EBITDA, and as a result, EBITDA will decrease. The right to use an asset, when a lessee obtains the right to use an asset, it could be bundled with other goods and services. The fact that there is a right to use an asset will give rise to a leasing arrangement and by default a finance lease arrangement. So in such circumstances, we got to dissect the lease payment as to what constitute for the right to use component of the lease arrangement versus the component of other payment, that is the non-lease arrangement payment. The implications of bundling goods and services with the right to use an asset is lessee can maximize the non-lease payment in the bundle to decrease the lease liability. The lease, in a leasing arrangement, the variable amount of the lease payment is excluded from the lease payment calculations, whereas the fixed payment of lease payments are included in the lease payment calculation. In a variable amount situation, it could be that the lease payment could vary with the number of tourists visiting the lease premises or the sales performance of the lease premises. Such variations due to factors that are linked to the lease payments are not included in the lease payment. On the other hand, if the lease payments are linked to some fixed payments, it could be the original fixed payment, and also it could be the lease payment that could increase as a result of inflation rate. Although the inflation rate changes, that change is constant across a year. So therefore, such increase is considered as fixed amount of payments and are included in the lease payment. Sometimes the variable amount of lease payment and the variable component of lease payment may require judgment.